Gold has been doing something interesting recently, and many middle-class investors are starting to notice it. For months, officials have been repeating the same message: inflation is cooling, the economy is stabilizing, and the worst financial pressure may already be behind us. But for many households, that message doesn't quite match reality. Grocery bills still feel higher than they did a few years ago. Housing remains expensive in many cities, insurance premiums keep rising, and saving money does not feel easier. At the same time, something else has been happening quietly in the background. Gold has been climbing again. Not suddenly or dramatically every day, but steadily enough that institutional investors and central banks are paying attention. That raises a deeper question. If inflation is supposedly under control, why is gold behaving like the financial system is still under pressure? To understand this, we need to talk about something that rarely appears in everyday headlines: liquidity. Not the simple idea of cash in your bank account, but the liquidity created when governments and central banks inject money into the financial system. Over the past 15 years, the United States has used several powerful tools to stabilize markets during economic stress. After the 2008 financial crisis, central banks launched massive quantitative easing programs. During the pandemic, governments introduced huge stimulus packages to prevent economic collapse. Each of those policies had a clear goal: stabilize the economy and prevent financial panic. But they also had another effect that is just as important. They dramatically increased the amount of money circulating through financial markets. During the pandemic response alone, trillions of dollars entered the economy in a relatively short period of time. That money helped businesses survive and supported households during lockdowns, but it also helped trigger one of the strongest inflation waves seen in decades. Today, official inflation numbers suggest that the worst of that surge may be behind us. However, markets are watching something more subtle happening beneath the surface. Liquidity is quietly expanding again, but this time through less obvious channels. Instead of large public stimulus programs, liquidity can enter the system through emergency lending facilities, bank support programs, or government spending financed by expanding debt. These mechanisms may not be described as money printing, but the economic effect can be similar. More liquidity enters the financial system, and asset prices begin to react. Gold has historically been one of the first assets to respond to these shifts. That is because gold does not only react to current inflation. It reacts to expectations about the future value of money. When investors believe the supply of currency may expand faster than economic productivity, they often move toward assets that cannot easily be created by policy decisions. Gold has filled that role for thousands of years. It is scarce, cannot be printed, and is globally recognized as a store of value. That is exactly why central banks themselves hold massive gold reserves. In recent years, central bank buying of gold has surged to levels rarely seen in modern history. According to data from the World Gold Council, global central banks have purchased unusually large amounts of gold over the past few years. Countries across Asia and the Middle East have steadily increased their reserves. China has been expanding its gold holdings, India has added to its reserves, and several emerging economies have begun diversifying away from heavy reliance on dollar assets. These moves are not random. They reflect a gradual shift in how governments think about financial security in an uncertain global environment. If global monetary conditions become unstable, gold offers a neutral reserve asset that does not depend on the policy decisions of any single country. For middle-class savers, these institutional decisions may feel distant, but they connect directly to everyday financial life. The value of savings, retirement accounts, and investments ultimately depends on the stability of the currency in which those assets are measured. When liquidity expands too quickly, purchasing power can quietly erode over time. That erosion rarely appears as a sudden collapse. Instead, it shows up gradually. Prices rise slowly, living costs increase year after year, and savings begin to buy slightly less than they once did. Many households experience this as a vague feeling that money simply does not stretch as far as it used to. Another reason gold reacts to liquidity shifts involves interest rates. When interest rates are high relative to inflation, holding cash or bonds becomes attractive because savers earn meaningful returns. But when real interest rates fall closer to zero, or even become negative after adjusting for inflation, the opportunity cost of holding gold declines significantly. In those conditions, gold becomes more competitive as a store of value compared to traditional savings instruments. Over the past few years, central banks have been trying to balance two difficult objectives at the same time. They want to control inflation while also preventing financial instability. Sometimes those goals conflict with each other. Higher interest rates may slow inflation, but they can also place pressure on banks, real estate markets, and government debt. When financial stress begins to appear in those areas, policymakers sometimes introduce targeted liquidity support to prevent wider problems. From the outside, this can look confusing. Interest rates may remain relatively high, yet liquidity still enters the system through specialized financial channels. Markets often recognize these contradictions quickly, and gold tends to react earlier than the broader public expects. Of course, this does not mean gold will move upward in a perfectly straight line. Markets rarely behave that cleanly. Gold can experience corrections, sideways movements, and periods of volatility. But the underlying structural forces driving demand often matter more than short-term price swings. Another major factor influencing gold is government debt. The United States currently carries federal debt measured in the tens of trillions of dollars, and servicing that debt becomes increasingly expensive when interest rates remain elevated. Historically, heavily indebted economies often rely on a mix of economic growth, inflation, and monetary flexibility to manage large debt burdens. Markets tend to anticipate these long-term dynamics long before policymakers openly discuss them. Gold's recent strength may partly reflect those expectations about the future direction of monetary policy. Geopolitics also plays a role. When global tensions rise, investors often shift toward assets considered safe during periods of uncertainty. Conflicts, sanctions, and trade fragmentation can weaken confidence in traditional financial arrangements, and gold has historically benefited during those moments. Because gold is not tied to the policy decisions of any single government, it often functions as a global confidence indicator. For middle-class investors, none of this necessarily means panic is justified. However, awareness of these trends can be valuable. Financial systems tend to evolve slowly, and then change quickly once certain pressures accumulate. Liquidity expansions today may not immediately translate into higher prices tomorrow, but they can shape the financial environment for years to come. Gold noticing these shifts earlier than many people is not unusual. Throughout financial history, gold has often reacted before broader economic narratives change. That leaves us with an important question. If liquidity is quietly expanding again beneath the surface, and institutions are positioning for potential currency shifts, how might that affect the long-term purchasing power of middle-class savings?